With the recent volatility contraction in Tesla, let's do a value and momentum analysis to see where to go from here. So the first thing that we want to look at is value. And when we look at value, we just want to look at fundamentals from a bottom-up perspective. And maybe if we want, we can add in some macro and a top-down afterwards. So the first thing that I want to look at is earnings. PE annualized from last quarter is 400. And clearly this is high. And so because of that, it's clearly a growth player. The main thing I want to look at over here is, though, how much will it grow? And is it going to grow for how long will it grow before it tops out, and how risky is that growth going to be? How risky are these cash flows also? And when I took the PE, I took it annualized from last quarter's earnings, because the problem with taking the whole year's PE is that it would be negative, because Tesla was losing money for the last year. Just last quarter it made a large amount in profits, and so I decided to use last quarter's earnings as a proxy for the future. But I annualized last quarter's earnings, and that's how I got that PE ratio. So let's look at the debt first. It's going to tell us the risk of those free cash flows. So remember, when you're valuing an equity from bottom-up perspective, is cash flows from a current perspective relative to cash flows from a future perspective relative to the risk of those cash flows. So you have current cash flows relative to cash flow growth relative to cash flow contraction. Let's look at cash flow contraction first. That's the risk right there. That is the risk that those cash flows will go down because of this debt. So does Tesla have enough operating income to pay off debt? Debt right now is $13.34 billion. Cash equivalents is $4 billion, and that's as of mid-late 2018. They have enough of a growing cash pile to pay off short-term liabilities and enough free cash flow to pay off long-term liabilities. And they're doing a secondary offering, and the underlying actually popped up on that secondary offering. So right now, from this perspective of risk and the perspective of how risky the cash flows are, they don't seem awfully risky. The only problem is the macro, and we would have to take that into consideration and see how much risk the macro has on these cash flows. Let's look at the flip side of it. So you have current cash flows relative to the contraction in those cash flows relative to the growth. So let's look at the growth right now. Tesla has growth of 400% annually, and that's if the current trend continues. The big question just becomes, will it continue? For the current secular trend to continue, there would need to be continuation of the current economic growth, and coronavirus would have to stay contained along with few newcomers as competition. And also, in China, we would need to see the Chinese economy actually keeping up, and we're seeing lots of contraction over there. And China has had a big debt problem, and it has a real estate bubble, and that is actually adding on to the demand for Teslas, is because of the wealth being created right there. Will that stop? If that stops, then this growth would stop. And so that's definitely something else you have to watch out for. Another way of looking at this is that, yes, you could, from bottom-up perspective, do a valuation and then add on some top-down macro and do that valuation, just like I said, of looking at cash flow relative to the future growth in those cash flows relative to the future contraction in those cash flows. But another thing you could do is you could look at it from a pure value perspective without looking at how much that business model of that business produces in operating income. So when we look at valuations, the PB is 22. We also want to remember that Tesla has a brand moat, and on top of the brand moat, it has another moat where if a competitor wants to come in, then what would have to happen is that they would have to spend hundreds of millions, if not billions of dollars to compete with Tesla, and that right there clearly creates this barrier. But I don't think the current growth trends are going to continue because of macro reasons. A PE of 100 is expected 2 years from now, but after that, growth is going to slow significantly. And a good valuation would be around $230. That includes the risk of a mild recession starting in 2 years, assuming normal inflation of 3% during the recession. Now, going back to the PB ratio, if I just said that cash flows are the way that you want to value an equity, why are we looking at the PB ratio and the intrinsic value? Well, another way that many people value equities is that they look at the book value or the intrinsic value, because you might have a company, for example, that has an intrinsic value of 10 million, but that only trades on the market for 5 million. So you could buy for 5 million, liquidate it for 10 million, and you make the spread or the difference between the two. And that's what many people like Warren Buffett did in the beginning. Benjamin Graham did that a lot. So that's another thing that you also want to look at is just the intrinsic value, but also you want to look at how much the return on assets or the cash flow being produced by those assets that make up the intrinsic value is. Okay, so from a technical perspective, the first thing that we of course see is a price, but then around the price we see the Bollinger Bands. So with the Bollinger Bands, we're seeing that there's lots of volatility contraction right now, and so when the volatility expands, that's probably going to take another month or so, but when that volatility expands, it creates more opportunity for us. And then another thing that you see is rising wedge. There's short-term upward momentum, even though the fundamentals say that you should be bearish, there's momentum to the upside. It's above its 20-day moving average, and there's a golden cross on the 50 and the 200 day. And so clearly it's looking bullish right there. When it comes to overbought, oversold, we're straight in the middle right now. We're in a normal range. It's not overbought, it's not oversold, according to the CCI. Okay, so things to remember in the final trade. Remember to price an M2 money supply over the long term because Tesla could go down in real terms, but up in nominal terms due to a growing money supply, and it's growing at 20+% annually right now. We want to be long to 805 calls, February 21st expiration, short to 830 calls, same expiration, short 1 800 put, same exact expiration, long 1 800 put, September expiration. So the reason we want to do this is because there's short-term upward momentum, and that's what the calls give us. The call vertical spread right there gives that to us, but the put calendar spread gives us a longer-term bearish viewpoint, and this trade allows for 2 times leverage to the upside with limited downside risk, and it's positive theta too. And it's a way to play with long volatility since Tesla's currently in consolidation and has had a lots of volatility contraction, but I think it will expand in the future. And this is being recorded when the underlying stands at 800.